Welcome back. We have Mr. Venkatraman, the Executive Director and CFO at Happiest Minds, along with Joseph Anantharaju, the Executive Vice Chairman, President and CEO of Product Engineering Services at the company, joining us this morning on those earnings. Thanks so much for joining us. Mr. Venkatraman, if I could start off with you. While we've seen a strong EBITDA margin expansion as well as growth coming in for revenue as well, what led to the decline that we've seen in profits this time around?
So the primary difference between the PAT of last quarter, Q1, and Q2, that's this quarter, has been the accounting for deferred taxes that we did when we closed the books for Q1. Earlier, we were following a very conservative base of accounting and not recognizing deferred tax assets. But when it came to Q1, it was part of our RHP while we were going public, and the need to recognize the deferred tax asset of about 17 crores was felt, and that had to be done. So we had a charge or a tax provision of about 8.5 crores and a deferred tax asset creation or a credit to the P&L of about 17.5 crores, so which was a net a credit of about 9 crores. From quarter two, what's happened is that creation of asset is no longer there. We are now on a standard charge creation, which is about 8.5 crores. So that's been the only change between Q1 and Q2 when it came to the numbers between EBITDA and PAT. But like you rightly said, the health of the business essentially is to be gauged based on the EBITDA percentage or margins, which is 25.6% in Q1, and now we are at a healthy 26.3%.
Sure. What led to the improved EBITDA margin expansion as well, and at what range do you see EBITDA margins sustaining, let's say, over the next 1 to 2 years?
What we have been able to do over quarter one is improve utilization. So utilization, which was about 75%, has gone up to 78% plus in Q2. So that's the improvement which has really helped us consolidate our margins a little more. All the cost savings that inured or accrued in Q1 in terms of work from home, benefits of work from home, continue to happen in Q2. So essentially it's been a growth in revenues plus improvement in utilization in Q2, which has helped us improve our margins. Now, coming to what we are seeing as stable margins, even during our post-IPO and pre-IPO roadshows, we had mentioned that while right now we were looking at margins which are very close to the large companies, we would be investing a large part of this into growth of business. And what would be sustainable as we go forward would be something lower than what we had projected in Q1. But right now at 26.3, we seem to have bettered it. I would request that what we happened in Q1, we have been able to do in Q2, and hopefully we should be able to maintain it in Q3, Q4. And after that, once things start becoming a little bit more normal, we would tend towards going towards normal margins, margin percentages. But essentially, the story will be to grow the revenues so that in absolute terms, our EBITDA keeps improving.
Joseph, if I could come to you, we've seen dollar revenue growth at about 5.4%. What is the kind of revenue growth that you've clocked in constant currency terms? And could you share with us which segments and sectors contributed to the incremental revenues?
So in constant currency terms, if you take in rupee terms, we had a growth of 0.5%, and there was the impact of the dollar, in that number. But if we look at, where we've got the growth or where we're getting traction, there are a few industries where we are seeing, a fallout of COVID and also a rebound. We're seeing more activity, and these are the industries from which we've got our business. We're looking at edutech, where there's a fair bit of new work happening, and therefore, requirements and projects coming up. We have high tech also continuing to do well. Industrial, which had hunkered down a little bit, has started new initiatives around digitization, e-commerce, and we are also seeing, in terms of online or digital media, companies spending a fair bit. We're able to close 8 logos in Q2, and apart from that, we've seen quite a few opportunities in our existing customers where we've been able to expand.
Sure. Joseph, but what's the kind of revenue growth or guidance that we can expect for the second half?
So, not we want to give a guidance. That's not something we're doing, but broadly, I think in terms of pipeline, there was a good pickup in Q2, and for the second half, our focus will be on ensuring that some of these opportunities that we have in our pipeline, we're able to close those. Continue looking at our large customers to expand, and the third would be the new logos that we've closed in Q1 and Q2. We want to put the effort to understand the customer better and make sure that we get our expansion and account mining strategy in place, because one of our key strategies is land and expand, and these logos that we've signed in H1 give us the opportunity to do that in H2 and also set up the base for next year.
So, while you've added 8 new clients and you're seeing pricing pressure as well, what's the kind of client feedback that you're getting?
So, in terms of client behavior, as I was mentioning earlier, we're seeing customers opening up and looking at new initiatives. And we've, to reiterate what Venkat said, we've not really seen any pricing pressure from customers. And I think a big part of it is because we're working with customers in some of their digitization and modernization efforts, which are quite critical and would have an impact on their revenues. And again, finding skills in these areas is difficult for them, and therefore there is not as much of a pricing pressure in the areas that we are working with, and we are able to hold our rates and prices with our customers.
Okay, fair enough. And Joseph, how are you seeing demand across segments? A large part of revenues as well come from the United States. What kind of revenue traction are you seeing across your geographies?
So in terms of geography, I think the good part is that we are seeing demand from all our main, the geos that we are focused on, and we are having activity whether it's Australia, Middle East, India, Europe, and US. We had 2 new logos out of the 8 from Europe, which is good, 25%, even though Europe is around 11% or so of our revenue. So that's an area of focus for us, and it's good to see, traction over there. And in terms of industries, if you look at some of the industries where we are having additional demand and incremental revenue, EduTech is one where a lot of our customers are trying to support more of online learning and also take a data-driven approach in both managing their students as well as the overall faculty and the operations. Second is around retail, where the efforts around e-commerce have really accelerated in the last 6 months, because that's an area where, given COVID, customers want to have as little touch point as possible, and therefore there's huge investments being made both again on online and lot on the data side, trying to figure out customers better and do things like personalization, recommendation. The third area is around high tech, because there's so much of technology that's being demanded now. There continues to be an investment, and this is an area that's seeing increased revenue. So they're also spending to add more features and to bring out new products. The fourth is around industrial, and manufacturing. Here, what we're seeing is more, efforts around automation and around digitization and e-commerce. So again, that's an industry. And the fifth area where we are seeing fair bit of traction is in the BFSI space, where online banking and anything related to online is customers are spending more to improve user experience, to improve user interface, and make it easier for customers to bank. The last area where we are seeing traction is in digital media. The equivalents of Netflixes, Hulu's and others, where again, with people staying at home, there's been an increased consumption of online media, and therefore there's more spend happening in these industries.
Venkatraman, the return ratios as well, they've been very strong. What is the kind of improvement that we can expect going forward when it comes to your ratios and your overall utilization?
Utilization is something that we would like to maintain at the current rate, which is at about 78 plus percentage, as I mentioned. So that's something that we will keep our eyes on. We had improved it from Q1 to Q2, and now not letting go of that would be the focus. Second is return ratios at about 36% plus annualized. We are continuing to keep that number high, and that's again will be an area of focus to keep and maintain at those levels, essentially by increasing your profit absolute numbers, which we will do looking into Q3, Q4, which is what Joseph mentioned through appropriate revenue growth and focus on that point. When I was referring to the normalization of profits, it was more from a percentage to revenue terms, because we were thinking more so in the between 22 to 23 kind of a percentage number is what we would have planned for. But we have got this slight increase more than that because of the cost savings that we have seen during the COVID pandemic. And we have been actually able to work, deliver and bill without any reduction in efficiency. But there have been quite a bit of cost savings that have happened, like visa costs have come down, travel costs have come down. Rentals, we have been able to renegotiate our rental payments. So there are quite a bit of those savings which are helping us in the current quarter. And something which can be replicated in Q3, Q4, and the learnings that have happened right now, we will surely replicate going forward in the future quarters as well.
Sure. Last question, and Joseph or Venkat, any of you could really answer this. We've seen a fairly dramatic turn with respect to the US elections. While an outcome is yet to be announced, do you see any impact of the outcome bearing on your business?
So far, at least leading up to the election, we didn't see any decisions or any flag off in terms of customer initiatives or their plans and strategy. The results are still coming in, but I think with the Senate being with the Republicans, there's more comfort in the business community that the tax structure will not be changed, and I think that will be a big relief. The other question people are looking for is the stimulus deal, because that's the other thing that would help with economic growth and with economic activity, and they've already started talking about it. So far, our view is that things should continue as they are, and there shouldn't be any impact.
From an Indian context, it's leading to a slight depreciation in the rupee, which even though maybe temporary, it's helping us.
Well, we'll have to just wait and watch. But thank you so much, gentlemen, for sharing with us the outlook on the company, as well as what you're looking at in terms of your revenue growth, demand across segments, as well as your healthy quarterly performance. That's the view coming in from Happiest Minds, and that stock continues to remain in focus. But let's get a